1 minute smarter, every market clearer. Welcome to my channel, I'm Claire. Hello everyone and welcome to today's podcast. I'm your host. Today, we're going to explore a profound subject that might make many people feel uneasy, but it's one we absolutely must face. Let's start with a highly deceptive numbers game. Imagine you have 1 million in the bank with an annual interest rate of 2%. Meanwhile, the price increase for that year, the inflation rate, is 3%. On paper, it looks like you've simply earned 1% less interest rather than losing money, right? But interestingly, data shows that this boiling frog process is essentially the largest and most legal transfer of wealth in human history. This seemingly tiny interest rate gap is quietly devouring the fruits of your labor from the past several decades. I find the following point very fascinating. While most people were still immersed in the relaxed holiday atmosphere, a violent turning point occurred in the global financial system in December 2025, one that could define the wealth landscape for the next decade. The Federal Reserve officially announced the end of quantitative tightening, QT, and within just 24 hours injected as much as $13.5 billion in liquidity into the market. If you have no concept of that number, let's look closer. This is the second highest single-day capital injection by the Fed since the 2020 COVID-19 pandemic. This is by no means a simple fine-tuning of monetary policy. It is a complete reset of the rules. What we are going to deeply deconstruct today is the Federal Reserve's new monetary strategy for 2026. In an era where AI is advancing at breakneck speed and the value of labor is facing a total reconstruction, why is working hard no longer the sole path to wealth growth? Why, in the upcoming cycle of monetary expansion, has becoming an investor shifted from being an option to a necessity for survival? First, we need to see clearly what exactly happened in December 2025. In financial circles, the keyword for the past few years has been quantitative tightening. Simply put, the Fed has been withdrawing US dollars from the market, trying to cool down an overheating economy to fight inflation. However, in the final month of 2025, that gate was completely shut. The Fed gave an extremely clear and heavyweight commitment. Starting from 2026, it will inject at least $40 billion into the market every month. This means the pendulum of monetary policy has swung completely from contraction to expansion. Why is the Fed acting with such urgency? On the surface, it's to deal with a weakening labor market and slowing economic growth. But I've found that the deeper reason revealed in the data is more brutal. The massive interest on federal debt has become an unbearable burden for the U.S. government. When interest expenses begin to severely squeeze fiscal space, the Fed's almost only choice is to make money more plentiful, thereby making the debt relatively lighter. This is the first layer of truth we must face. The money supply is not constant. It is a digit that can be manufactured at any time according to need. And when this manufacturing process accelerates, every banknote in your hand is actually undergoing an invisible dilution. To help everyone understand this dilution effect, we can use a simple mathematical model. Imagine if there were only $100 in the total world and you had $1, you would own 1% of global wealth. But if the Fed prints another $100 overnight, even though you still have that same $1, your share of wealth has dropped to 0.5%. This is the reality we are about to face in 2026. With the continuous injection of $40 billion per month, the US dollar supply will once again enter an upward channel. We can do a more specific calculation. Suppose the inflation rate in 2026 stays around 3%, which is a very conservative estimate during a period of monetary expansion. If you put $1 million in the bank, and the bank gives you 2% interest, the number in your account becomes $2 million after a year. But interestingly, what $1 million could originally buy now requires $1. $3 million. In this back and forth, your actual purchasing power has lost a full $10,000. This is the so-called invisible tax. You didn't receive any tax bill, but your wealth has indeed decreased. An even more interesting point is that this impact is even more brutal when it comes to wages. Most people believe that as long as they get a 3% raise every year, they can keep up with the pace of life. But in the context of a monetary reset, the price of assets often rises far beyond the price of goods, and the price of goods often rises faster than wages. When companies face rising costs for raw materials, rent, and financing, the first thing they usually do is control labor costs. If your salary growth rate is lower than the expansion rate of the money supply, you are, in essence, becoming poorer. To see the future clearly, we must look back at two pivotal turning points in history. The first was in 1971. That was the year President Nixon announced that the US dollar would be decoupled from the gold standard. Before that, for every dollar the Fed printed, there had to be a corresponding amount of gold in the warehouse. Back then, money was honest. But after 1971, the dollar became purely a credit currency. Behind it was no longer gold, but the government's ability to tax and its sovereign credit. From that moment on, humanity entered an era of bottomless money printing. History tells us that when a government faces a debt crisis, sacrificing the value of the currency is almost its only escape route. The second key turning point was the 2020 pandemic outbreak, when the Fed opened the floodgates for unprecedented liquidity. At that time, money entered the economy through unemployment benefits, government checks, and corporate loans. That flood directly led to the subsequent global inflationary tsunami. However, interestingly, data shows that if you chose to hold cash and wait-and-see at that time, you are now facing soaring rents and high prices. But if you had bought the S&P 500 then, your wealth would have already doubled. Interestingly, the 2026 reset is fundamentally different from 2020. In 2020, part of the money was sent directly into the hands of ordinary people, but the liquidity in 2026 will more directly push up asset prices through the financial system. More importantly, this time we have introduced a massive variable: AI. In traditional economic logic, when the Fed prints money and lowers interest rates, companies borrow to expand production, thereby hiring more people and driving employment. This is known as the trickle-down effect. But in 2026, this logical chain is broken. I find this point very fascinating. When companies today get cheap capital, the first thing they think of isn't hiring more people, but automation. When a company finds that the cost of purchasing AI computing power and automation software is lower than hiring employees, they will choose the former without hesitation. This means that while the new money created by the Fed pushes up corporate profits, it will not benefit workers proportionally. We will see a very eerie phenomenon: corporate profits hitting record highs and the stock market climbing steadily, while the job market remains dead silent and wages for ordinary people stagnate. AI is accelerating the decoupling of capital from labor. In 2026, this money will stay more on the supply side and the asset side. If you are merely a laborer, it will be very difficult for you to share in this round of dividends. You might even lose your bargaining power due to AI competition. This requires a transformation in our identity. This transformation is essentially moving from being a passive recipient of rules to a beneficiary of rules. Many people feel pain because they are trying to play a game where the underlying code has been updated using an old logic of survival. We must understand that the design of the modern economic system is inherently tilted toward asset owners. Let's look closely at this wealth flow model. When the Fed injects funds, big banks get the money first, which then flows to large corporations and Wall Street. Companies use this money to buy back shares and upgrade AI technology, which pushes up stock prices and benefits investors who hold those stocks. Ordinary consumers are at the end of this chain. By the time the money reaches you, it has already pushed up the price of housing, bread, and gasoline. There are two types of people in this system. The first are those who sell their time, the workers. Your compensation is rigid, raises require long negotiations, and due to AI competition, your bargaining power is shrinking. The second are those who hold assets, the investors. Your wealth floats automatically with the increase in the money supply. When there is more money, your asset numbers get bigger. Wall Street welcomes expansionary policies because they know every instance of money printing is a repricing of existing assets. If you don't have assets in your hands, you are destined to be the denominator that gets diluted. So, facing the 2026 reset, what should an ordinary person do? First, let's talk about passive investing, which is the most solid cornerstone for protecting wealth. I highly advocate for a principle: always be buying. In a monetary expansion cycle, trying to time the market or guess the bottom is extremely dangerous and inefficient because the printing press offsets many normal corrections. For the vast majority of people, the simplest strategy is to regularly invest in broad market indices, such as an S&P 500 ETF. Why choose the S&P 500? Because it represents the 500 most competitive companies in the U.S. economy. No matter which AI company wins in the future, or which industry rises, it will be included in the index. The core logic here is the power of compound interest. Let's look at a very fascinating set of data. Many people look down on a return of about 10% per year, but if you can stick with it for 30 years and invest $1,000 every month, with a 10% annualized return, you will eventually have nearly $2. 26 million in wealth. In this process, you don't need to be an investment genius. You just need to be the person who stays in the market. The essence of passive investing is to transform you from a simple laborer into a shareholder, sharing the profits of the world's top companies. Of course, if you want to run faster, you need to engage in active investing. While passive investing allows you to keep up with the market's pace, under the dual pressure of a monetary reset and the AI revolution, you may need to pursue higher alpha returns. That is, excess returns. Here is a comparison of data that is quite thought-provoking. Similarly, investing $1,000 a month for 30 years, strategy A has an annualized return of 10%, and you eventually get $2. 26 million. But if through active investing you achieve an annualized return of 12%, the final wealth obtained is approximately $3. $50 million. Interestingly, a mere 2% annual difference results in a wealth gap of as much as $124 million after 30 years. This extra $24 million is the reward for your understanding of market laws, your discovery of high-quality companies, and your insight into macroeconomic policies. Active investing means you need to understand why certain companies with AI moats can earn excess profits in 2026. It is not speculation. It is standing in the path where capital is bound to flow. In a monetary expansion cycle, we must also mention two special classes of assets: gold and Bitcoin. Gold has been a consensus for thousands of years of human civilization. In essence, it is a vote of no confidence cast against the current monetary system. When you no longer trust the Fed or the purchasing power of sovereign currencies, you buy gold. In the context of 2026, gold is more like wealth insurance. It won't make you rich overnight, but it can help you maintain your purchasing power during periods of severe monetary upheaval. Bitcoin is called digital gold, and its logic lies in its fixed total supply of 21 million coins. Unlike the numbers the Fed can increase at will, Bitcoin's mathematical rules are unchangeable. For the younger generation and tech capital, it is a speculative investment against fiat dilution. Please note my wording: gold is insurance, while Bitcoin is a speculative investment. Allocating a small portion to hedging assets in 2026 is wise, as it can diversify your risk of being overly concentrated in fiat assets. Next, facing the upcoming year of 2026, we need to remain clear-headed. The Fed's policy reset does not mean the market will be smooth sailing. On the contrary, due to excess liquidity and the uncertainty of AI technology, volatility may become more intense. Many people will worry: what if there is a recession? What if the market crashes? My answer is, in the long run, asset prices are determined by supply and demand. On the demand side, as long as the world is still using the US dollar, and as long as the Fed continues to create dollars, there will be more and more capital chasing limited high-quality assets. On the supply side, The growth of prime land, ownership of top-tier companies, and scarce resources will never keep up with the speed of the printing press. So the conclusion is very simple. Money will increase, but the good things will not. The 2026 monetary reset is the end of an era and the beginning of another. We must understand that the financial system we live in was not designed to reward frugality and hard work. It is a system that rewards capital and cognition. This may sound a bit cold, but it is the real world we must face. If you refuse to participate in investing, you are refusing to share in the core dividends of this era. You are not only carrying a heavy shackle called inflation in the race toward the finish line, but you are also competing with AI that never tires. Do not complain about the unfairness of the system, because complaining cannot change your balance sheet. What we need to do is see the rules clearly and then join in. Whether you choose to invest a few $100s every month into an index fund or spend time studying the business models of the AI era, the most important point is, you must be in the game. When the flood of monetary expansion arrives, what you need is not to try and block the water, but to build an ark for yourself. Interestingly, current financial tools have already provided much convenience for ordinary people. For example, some platforms allow users to participate in the investment of the world's top companies through simple operations. Some platforms even offer extremely high annualized returns for idle funds, such as cash interest as high as 1%. The existence of such tools is essentially helping you fight against that 1% invisible loss. In this rapidly changing era, cognition is the only moat. I hope today's sharing allows you to see the truth of wealth flow at this critical turning point of 2026. Thank you for listening. If you found today's content inspiring, don't forget to start your journey of asset accumulation through action. As I have always emphasized, before the monetary flood arrives, please make sure you are already standing on the boat. Make sure to hit that like button and subscribe for more updates. Feel free to leave a comment. I'm looking forward to connecting with you. Until next time.